All right. So David Karpol sent me an email a while back, and he says, "Hey, give me a call if you want to see some of what I'm doing." He said it's kind of boring, but you might be interested in it. And so I ended up giving him a call, and he showed me something. It's like, this is pretty interesting. I'd kind of like to see more about this. So, oh, this is interesting. I got this pop up in the middle of my screen here. Okay. All right. So he had a there's a Nobel Prize paper that was written by Markowitz, and it is based on the efficient frontier. But it'd be interesting to start with, all the different people in our group have tried different kinds of strategies in the past to try to maintain a trend, to try to stay in some sort of into a decent position. I have a screen that's popping up on my screen here. I've got to figure out how to stop this. Hold on a second. I'm going to try to move this to another screen here, see if I can do that. You guys still see? No, you don't. You see me, right? Or you see the screen?
We see you.
Okay. All right. Yes. So I got to figure out how to share this. Let me try to share this as a very small. Yeah, this is the full screen. The stuff is popping up right in the middle of my screen, so I'm going to try to do to see what happens here. So let's give you an overview. So I'm going to go through a little bit of the group's history and attempts at various portfolios, and then we'll get into some modern portfolio theory. That was the Markowitz thing that I was talking about, with the big aha, at least the big aha for me. David's explanation, I had multiple ahas through his description of how this all works. And in the conclusion, in a spreadsheet demo, David hopefully has a spreadsheet that he has on his machine that's pretty intense. Mine is only a small sample of what he has, so stay tuned. So the key is, when you're getting into a long position, you want to somehow get some sort of negative correlation to smooth the curve. If you have like a 2-asset class scenario, for example, you have SPY and you have TLT, when SPY goes up, TLT goes down. TLT is bonds, and SPY, of course, is the stock market. And when you look at that, they're both trending higher, but they sort of offset each other. So this is a plot of, this is the top plot here is SPY. SPY is going down. TLT at the same time, this is going down. You see TLT going up. That's exactly what you want to see to try to smooth the curve. Not flatten the curve, people, smooth the curve. And so what you end up with is, this is the portfolio at the bottom, and it shows over from January 1st of this year to now, you're up about 9.5%. And the dip here was pretty dramatic. This was pretty 30% drawdown, and what you end up with here is a much smaller drawdown because you're offsetting with TLT. So that's one approach, just 2 stocks. Then we have other folks like myself and Steve and a few others are running the triple NASDAQ, TQQQ instead of triple stock. But then what happens is, you get some really great gains in the bull sense, but when TQQQ falls, nothing else seems to go up as fast or enough to compensate for the loss. Instead, what we do is we basically exit the trade. And it works great in the bull market, but not so good in the bear market if you're going long only. So I typically go long. Steve, I think, tends to go long. He actually has one which is uses fractals, which actually goes long and short. But typically, I just stick with the long side. And I think a number of members of our group also stick with the long side. But this is just basically sticking to one ETF. So you can see on this chart here, these are comparisons of, if you look at various stocks, you got Zoom and NVIDIA, Amazon, Netflix. all of those are stellar stocks from March, when we had the March low to now. Those things are really, really good. But when you look at TQQQ, it's pretty much beaten all of them. It basically comes close to Tesla, and it isn't quite as dynamic as Shopify. So to me, it's got the best of all worlds in terms of for a trader, from a trader standpoint. But maybe there's a better way. What about using modern portfolio theory? So modern portfolio theory talks about this concept of being on the efficient frontier. And these green dots are in effect various portfolios and ratios. So if you have one portfolio that has 10 shares of Amazon and 50 shares of Netflix, okay, that would be one portfolio. You put together all these different portfolios and they come out on a chart which shows the standard deviation, how much the portfolio varies, the variance about a trend and a expected return on capital. So the risk-free rate of return is down here, and then you get some sort of a plot. Best you can get is this point right here, which is minimize the risk and maximize the gain. So that's the theory. Well, that's the high-level view of the theory. And well, at the end, I'll show the paper that David sent me, which is pretty sophisticated. And thank goodness I had his spreadsheet together with that paper to make sense of it. So the big aha for me was shorting. So typically in modern portfolio theory, all the places I've ever known, they only go long stocks. And when I looked at his spreadsheet, he's just like, wait a minute. Well, we'll show that in a second. He's actually shorting at the same time. He's actually going long. So it kind of makes sense that, the market's going to be going, one's going to be going up, one's going to be going down. You short the two, and you got both of them going in the right direction. And some people would consider this a hedge. And I have been looking around and talking to various people for 10 years, and some people have said, oh, this is the way you hedge your stock. This is the way you hedge your stock. Like, I haven't found anything that seemed to do an effective job that wasn't kind of seat of the pants. This is not quite seat of the pants. So what David was showing me in his spreadsheets is he downloads the daily stock data. So you have Mac, IBM, AMD, Bio, now all these different stocks, and he downloads all of these stocks and dates and the prices. He's looking at only the closes, and then you basically figure out a portfolio, and you compare the portfolio against the stock. Correct me if I'm wrong here, David, if I'm making mistakes here. And you end up with another list. You basically compute the percent change. I'm building this thing up gradually. If I showed you the whole spreadsheet at one time, it's pretty amazing. So I'm just trying to show you the individual components as I understand them. And so here is portfolio performance. So all of those percentages are down below here, way down below on the spreadsheet. And you end up with a portfolio, and this is your holding size. And the holding size is got 10 shares of it, 10 shares of that. It's relative. It's relative to 100, I think it is. So you maybe have 10 shares of Bio, 10 shares of AMD, 10 shares of Now, or 10%, 7% of Now, 7.75% of Bio, and then you end up with a negative. This is where you start shorting some IBM and some Mac as well. So you're trying to optimize the variance here, how much the price varies, and still maintain a really reasonable return on capital. Okay, and this is the paper. This is the link to the paper, the Markowitz paper on portfolio theory. And he was the Nobel Prize. I guess he won the Nobel Prize for this. And by varying the holding size, you end up with a portfolio that is basically optimized to this variable, to this variance here. Actually, to this value here. You want to optimize this one that I have the arrow by to 3.41. That was the best with this given portfolio over the past 3 years. So this is a look at the historic portfolio. So each of these represent one of the stocks, and he's got it color coordinated so that that cyan one is the GE at the end here, and not cyan, fuchsia. So fuchsia is GE, and GE has been going down. Initially, when I looked at the spreadsheet that he had, it's like all these stocks are going down and these stocks are going up. How are you making money? This black line is the portfolio. That is really cool. And then, of course, the line down the center is the linear regression line through that. So that's kind of nice. However, if you look at the date on the bottom, this is July 2019. Well, what happened? So this is basically a back test, right? So you say a back test, here's a back test up to July 2019. Well, what happens if you go beyond that? Well, if you go beyond that, here's I basically tacked on another chart to it, and this is going just beyond it. The key was what happened in the early part of this year, the February-March timeframe. And this is when we had this major sell-off, right? So does it hold? Does this line, this trend, the portfolio performance continue along this line? And lo and behold, it did. And what you end up with is when it went down, when we had a severe crash here, the portfolio actually increased in value. This is so cool, so cool. I love it. So then I also did a portfolio sensitivity. I said, well, what happens if I don't exactly get all the right stocks? And I said, well, let me put in QQQ or something like that in the one that we're shorted. Well, it has an impact on the portfolio, but it's a minor impact. It's only a portion of the stock of the whole portfolio. So yeah, you lose a little bit. You don't gain as much, but it's not earth-shattering. It's like, okay, this thing can stand up to making mistakes. I like that too because I make a lot of mistakes. So the variance of the performance is impacted a bit, but since you got the diversification, it's nothing devastating. And what's also cool is that there's no stops required. Very, very nice. So conclusion for me is a modern portfolio theory with the efficient frontier is a good alternative for long-term investors. And the big aha for me was the shorting for some of the position. And how often do you rebalance? You rebalance every quarter or every year or whenever. I'll turn it over to David here. So something is simpler to manage.
I did for the guys. They're basically real estate guys, and
yeah.
So I try to simplify, and they put a symbol, and it downloads the data, and then the holding size is just a number, and then it calculates to percentage of the portfolio, so you can play with it. Also, the correlation tells you how it correlates to your basket. So if you need to short or long it just gives you an idea how to play with the holding size.
Right. So this basically shows about 10 stocks. So anyway, this is basically a 10 stock portfolio, and it allows you to, the spreadsheet allows you to fiddle with the numbers in here and see how to maximize this 3.25. See if you can do that. It's by hand as opposed to using the Excel optimizer. Or
what is that? What is that bottom line represent? Is that your correlation factor, or
no? It's the Markowitz mean variance. Okay, go ahead.
Okay, what is that? What is that? What is that?
The bottom line gives you the ratio of your gain versus the volatility. So
if
you
you
want the
take-
maximum gain to the minimum volatility.
So if you take the 5.54% divided by the
Divided by
variance,
the variance,
16%,
Yeah.
and that's what this is. So we can actually take a look at that on there. You can see what it is here. So when I click on that cell, you can actually see it. So when you get this, when you download this from the Excess Profits website, so I actually played around with this quite a bit, and I've also modified it a little bit because David was mentioning that he's using more than 100% margin, 100%, 120% of his margin. And so what I was trying to understand is, if you look at this holding size, and if you add up all these numbers, -44, -3, 10, etc., you end up with a -9. So it's a slight bias, a negative bias on the market, which is pretty cool. And it ends up being a pretty decent, the plot, the net result here, this plot here, ends up being a pretty good continuation of a nice trend.
Is there a way to hedge if you don't want to take the risk and basically do margin and short the stocks to the extent that you're doing it? What about using like QQQ or some other hedging type stocks to do it if you don't feel if you want to kind of get into this slowly and you're not comfortable yet to do that type of hedging that you're doing, I mean shorting that you're doing?
You
have to, what I was saying?
It doesn't work.
Does that make sense, David?
Without shorting, it doesn't work.
Well, is there a way to